Shannons Demon is a technique that shows how to create returns literally from thin air. No joke. We will see how to use this technique to increase the portfolio returns over time or decrease the risk. First, about the technique. This little known and fascinating concept mixes two assets such as equity and debt. These can be combined together to create a positive portfolio return even when the individual components are expected to produce negative or zero return. Think of this game. A coin is flipped. If it lands on heads, you make 50% return. If it lands on tails, you lose 33%. So rupees 100 becomes 150 if you land on heads. In the next flip, if you land on tails, 150 dials down to 100. Let's see a few iterations. You land heads first. Your 100 rupees gets 50% return, becomes 150, which you play in the next round. Next flip is a tail. You lose 33% or 50 rupees lost. So your portfolio value becomes 100. If you play this game long enough, you have an equal chance of landing on heads or tails. Hence, the portfolio ends up being what it started with. Zero profit. In equity terms, this is how this graph looks, the zero-sum game. Now, what if you decide to rebalance 50% before every toss? Meaning, you take 50% cash off the portfolio and keep it away, earning 0% return. And you play the game with the balance 50% or rupees 50. And you land heads. You make 50% return. So the final value is 50 plus 50 and 25, 125. So the total profit you have made is 25. Your starting value now is 125. Before the next flip, you take 50% cash off and you keep it safe, earning 0%. So 62 rupees 50 paise is then played. You land tails, you lose 33% or 20.83. So the final value is 62 plus 62 minus 20. Your portfolio is now 104. So the net profit at this stage is 4 rupees. Your starting value now is 104 and you repeat these iterations. After 10 such attempts, your portfolio has generated 22 rupees compared to zero expected return when the portfolio was not rebalanced. This drives the key point that even when two assets that have zero return expected or zero wealth generating capability, and if these are rebalanced regularly, we have a return generating portfolio. At the risk of oversimplifying a very exhaustive paper by Shannon, this is happening because when we rebalance, we reduce a very powerful negative force called volatility drag. You make returns over time by losing less and less to volatility drag. Diversification is called the only free lunch in investing. Not all investors can handle volatility and bear stock price meltdown. Their ability to handle drawdowns determines how long they can remain invested. And this makes compounding possible. That is where asset allocation and rebalancing helps to improve the investor's experience. He can create a portfolio with a volatility that he can withstand. If you're a moderate risk taker, you can consider investing 50% of your money in equity funds, possibly through SIPs. The remaining 50% can be allocated to a bond fund or an arbitrage fund. Regularly check your investment portfolio, especially if the market has gone up. If the allocation has shifted, like becoming 60% equity and 40% debt, rebalance it back to the original 50-50 ratio by switching some equity to debt. This helps you lock in the profits you made in equity and keep your money safe in the arbitrage fund. If you notice the portfolio becoming 40% equity and 60% debt, it means the equity markets have corrected. In this case, switch some debt to equity to bring it back to a 50-50 allocation. This way, you invest the profits saved in the arbitrage fund back into equity and at a lower rate. By following this 50-50 portfolio And rebalancing regularly, you protect your investments from downside, protect the profits made, and invest in equity at a lower rate. If you like the content of this video, please consider subscribing to this channel and sharing it with your friends. Like it.